Hello ladies and gentlemen, my name is Dylan Hamilton and welcome back to C.A.R. Entertainment. Today we're going to be continuing with our A21 Business Studies Revision videos, guys, and we're talking about ratio analysis. For AS, we're given the ratios, but this time you have to learn them all off, and it can be a wee bit tricky in the C aspect because the equations they give you to learn off aren't always the correct equations, because where you're picking the figures from can be different to where they specify. But in this video we're going to go over the things and where the substitutes may possibly be, so just so you know what all ratio analysis is very, very important to know. All the businesses will use them, especially those PLCs and LTDs. And that might be our penultimate video as well. We just have investment appraisal to do with A21 afterwards. But without further ado, let's go straight into it. So the first ratio you need to know is ROC or ROCE, and ROCE stands for Return on Capital Employed, and it relates a firm's profitability in relation to the investor's capital investment. So an ideal ROCE is 15% or over. You improve ROCE by increasing your operating profit or reducing your capital employed whilst maintaining your operating profit. So your first way of calculating ROCE is your profit before tax, add your finance costs onto that, then add preference dividends onto that, then divide that sum by total assets, take away total liabilities, and you will times that by 100. Now, if you don't have like finance costs or preference dividends or PBT in it, then you can use just simply net profit divided by capital employed times by 100. If you're in the C spec, definitely use the first one if you can. That's the one they'll be expecting you to use. Gross profit is the next one. The gross profit margin will show the gross profit made on sales turnover. The higher the gross profit is, the better it is. You can increase it by increasing prices, by not discounting, and having a better control of your supplier. Quite a simple equation. It's gross profit divided by sales revenue times by 100. Net profit, more or less the same thing, only it shows how well a business will control its overheads. Obviously, the higher the better, and to improve it, you reduce your overheads, reduce interest and debts. Its equation is pretty similar to gross profit. It's just net profit divided by sales revenue times by 100. The current ratio is a measure of a firm's ability to meet short-term obligations by collecting receivables and maintaining the cash position. The ideal is a 2-1, which basically means that with every one asset you can pay off 2 liabilities. So you can pay off your current liabilities and sell off unproductive assets to increase. You can reduce it, so if it's over 2-1, then you can reduce it by increasing your short-term debts or spending more cash optimally. To increase it, let's say it's 1.5, you want to increase it to 2.1, you pay off your current liabilities and sell off unproductive assets to increase it. Its equation is pretty simple: current assets over current liabilities, hence right, the current ratio. Gearing is the next ratio, and it will compare an owner's equity to the borrowed funds, and it will show how risky a business is financially, essentially how much of the business is financed through loans and borrowing. If it's lower than 25%, then the business is low geared. 25% to 50% is ideal, and then over 50% is highly geared. You can reduce your gearing by selling shares, reducing working capital, increasing profit, or increase working capital and taking more debt on. So the gearing equation is non-current liabilities divided by the equity capital plus reserves plus debt capital times by 100. The EPS is a new one. This is earnings per share. This will be expressed in pence if you're asked for units. It will measure. This measure will express how many pence the company is earning for every share sold, and the higher the better. You increase it by increasing revenue, having lower costs, or using share buybacks. EPS is calculated by the profit for the year divided by the number of ordinary shares in issue. The difference between earnings per share and return on capital employed is that earnings per share is the actual price they are making. So how many pence the company is earning for every share sold. So if the company shares 1,000 is sharing 1,000 shares, and they make 800, this is like someone maybe 600. That means there's 600 pence up. That means they're making 600 pence, aka £6, for every share they sell. So it basically means they're making £6 on for every one investment that a person makes. Whereas ROCE, if we go back to it, is how much profit the shareholder makes. So it's really giving away their dividend. So if the shareholder invests £1,000 and their ROCE is 10%, that means they're going to make a £100 profit. Their dividend should be about 1,100. ROE, similar again, is return of equity. This is ROE, and that is a measure of how well a company uses reinvested earnings to generate additional earnings. The higher the better it is. It will increase the profit margin, and you increase your profit margin, and you improve asset turnover or distribute idle cash. You calculate ROE by taking your preference dividend away from your net profit, and then divide this by ordinary share capital plus reserves and times it by 100. There's differences that you need to know between cash and profit and different factors that affect ratios. The main factor is, of course, inflation, but performance of the company and the state of the economy also are factors. The difference between cash and profit you need to know is that cash is a liquid asset of a business as the inflow of money into a business and also then into cash moves out, whereas profit is just money earned by the business, and this is represented on a bit of paper. The advantages of using ratio analysis is that it can make financial data more meaningful, it can help determine relative magnitude of financial quantities, whilst a system of predicting potential business earnings. It can also assist in seeing financial business strength, and it can assist in spotting business weaknesses. The disadvantages is that it gives current and past trends but not future trends, which is what of course a business wants. The impact of inflation may not properly be reflected, as many figures are taken at historical numbers and they're several years old, and ratios are actually only as good as or bad as the underlying information used to calculate them. Thanks for watching this video. I've been Dylan Hamilton from C.A.R Entertainment, and I will see you next time.